Hi, my name is Frankie. Welcome to FAQ Show. At the start of the second half of 2025, the S&P 500 hit all-time high again. Feeling uneasy about it because you are unsure if it is still a good time to invest in the market? You are not alone. Many investors get nervous about investing when the market is at a record, thinking all the gains have been gotten. It seems counterintuitive to buy when prices have never been higher. And yet, if the market is so expensive right now, I still see many people around me making good money from it. Today, I want to take you on a deep dive into exactly that question. We'll explore why the current climate actually favors people who choose to actively trade, how they are profiting in a high market, and what you can do to sharpen your own trading skills to take advantage. By the end of this video, you might just rethink your approach. Let's get started. As of mid-2025, the US stock have staged a remarkable recovery from a springtime plunge earlier in the year. Just a few months ago, fears over trade wars and tariffs sent the market tumbling roughly 20% in a correction. But since then, the losses have been erased and the index shot up to new highs. The term all-time high sounds very scary, as though a steep fall could be on the horizon. But well, markets hitting new highs is not as rare or as alarming as many may think. Historically, all-time highs are actually quite common. Since the 1950s, the S&P 500 has made over 1,200 new highs, averaging more than 17 new highs every single year, which is about 1 in every 20 trading days. And far from always crashing after a peak, new highs are often followed by more new highs in the period that follows. What does that even mean? In simple terms, an all-time high by itself isn't a stop sign for the market. The market can, and often does, continue to climb higher after reaching records. So if you're feeling fear of heights right now, remember that new peaks are a normal part of a long-term market growth. For long-term investors, time in the market typically beats trying to time the market. But what if you are not just a passive long-term investor? What if you want to actively capitalize on these moves? That's where being a trader comes in. Okay, that doesn't mean blindly jumping in because stocks always go up. Not at all. What it means is we shouldn't just freeze just because we see a high. We should try to understand the current landscape and assess the risk. The reality is that today's record high market has some unique characteristics that make it tricky for traditional buy and hold investing, but potentially very lucrative for short-term trading. Let's talk about why. This year's market rally has been anything but a smooth ride. Under the surface of that steady climb to records, there have been wild swings and sudden drops, the kind of volatility that can shake out even seasoned investors. But guess what? Active traders thrive on exactly this kind of turbulence. 2025 has truly become a trader's market, where being nimble and opportunistic pays off. Just look at what happened in the first half of 2025. The S&P 500 saw a series of sharp sell-offs followed by rapid rebounds. For example, after Liberation Day tariffs were announced in early April, the S&P 500 plunged about 12% in a matter of days, only to fully recover those losses within 1 month. There have been multiple such swings, and each time, traders who bravely bought the dips were rewarded. In fact, those stomach-churning drops turned out to be ideal buying opportunities as the market rebounded back to new highs repeatedly. By the end of June, the index was crushing at record highs again. For traders, this environment is a playground. Big intraday and week-to-week swings means more chances to trade, more ups and downs to profit from. One Bloomberg report highlighted how volatility-loving traders are reveling in the tariff-driven turbulence. Option traders who thrive on big swings have seen a surge in opportunities thanks to the constant back and forth triggered by current affairs. Think about it. In 2024, stocks were growing but rather slowly. For even a damn good day trader, they had to work hard for very little gains in that kind of market condition. But with 2025's wild swings, this person could be raking in 80% more profits than last year. They embrace it as a chance to make money. Broadly speaking, today we are in a headline-driven, event-reactive market, a trader's market in the purest sense. You see, Every other week, there's a market-moving headline, a new tariff threat or delay, a surprise economic report, a geopolitical flare-up or peace deal. In early May, news of the US striking a trade deal with the UK, and later a tariff pause agreement with China helped dig the S&P 500 out of its hole. Then, late June brought an Israel-Iran ceasefire and US actions to neutralize certain threats, which gave stocks another shot upwards. On the flip side, a single tweet or statement about new tariffs can send shares tumbling down in minutes. Actually, for small traders like us, this situation is ideal. All we have to do is to turn a little bit more risk on, trade the news, and capitalize on short-lived mispricings. If you stay alert and adaptive, you can profit whether the market rises or falls. The great news is that volatility isn't something to fear right now. It's something you can turn to your advantage as an active trader. But before we get carried away, let me clarify. Trading a volatile market successfully requires skill, strategy, and discipline. It's not gambling, it's about understanding the drivers of these moves and reacting quickly but intelligently. Let's examine what exactly is happening behind the curtain of this market and why a traditional value investing approach might be less effective at the moment compared to a trading approach. It's easy to think that because the S&P 500 is at a record high, every stock must be doing well. But if we look closely, that's not really true. In reality, only a small group of stocks are pulling the whole market up, while many others are still struggling. This is why knowing which stocks to buy and when to buy them is so important right now. Here's an interesting fact. Even though the S&P 500 and Nasdaq reached new record highs at the end of June, they have only gone up by about 5% since the start of the year. You might wonder, how can that be? How can we be at record highs if we have only gained 5% this year? Well, earlier in the year, the market actually fell quite a lot during the spring season. Since then, it has recovered, but most of the recovery came from just a few big tech companies that benefited from the AI boom. Many other stocks are still not back to where they were before the drop. So, even though the news talks about the market being at record highs, most people's investment might not feel like they are at a record high, especially if they didn't invest in those few winning stocks. About half of the S&P 500 companies are currently trading below their 200-day moving average, a classic technical indicator of long-term trend health. In the entire US market, fewer than 800 stocks are in a clear uptrend. That's roughly 13% of stocks showing sustained strength, while the other 87% are either flat or trending down. In other words, the rally has been extremely selective. A short list of high-growth sectors and names is pulling the market higher, and if you weren't in those, you might be lagging badly. What sectors are we talking about? As of mid-2025, the leaders include areas like AI and machine learning, clean energy, healthcare technology, cybersecurity, and robotics. These themes captured the market's imagination this year. And the biggest winners, often dubbed the Magnificent Seven, are the mega-cap tech giants at the forefront of AI and cloud computing. In fact, the top 7 tech companies have grown so much that they comprise a huge chunk of the S&P 500's value. Their outsized gains have masked a lot of weakness underneath. Because only a small group of stocks are leading the market right now, there are a few important things we need to think about. Number 1, they might be running out of steam. Some experts believe that these leading stocks might have already gone up as much as they can for now. If any positive expectations with regards to these stocks don't happen, for example, if AI doesn't bring in as much profit as people hope, or if trade tensions get worse again, these stocks could drop easily. Number 2, money might start moving to other sectors. If these leading stocks take a break or stop going up, investors might start putting their money into other sectors instead. Actually, we are already seeing this happening right now towards the end of June. Suddenly, financial stocks started to rise, not just tech stocks. This is actually a healthy sign because it means the market rally is spreading out. For traders, spotting these shifts early is important. Imagine you only held tech stocks and didn't notice that banks were starting to go up because of new regulatory changes. You might have missed that opportunity. Being aware of where money is moving can help you catch the next wave of gains. Number 3, Choosing the right stock is very important right now. Because only about 13% of stocks are in a strong upward trend, you can't just buy any stock and expect it to go up. Simply buy the entire market like an index fund might give you only a small return. Remember, the S&P 500 is up only 5% this year. But if you focus on the stronger sectors or companies, your returns could be much higher. For example, Nvidia had a tough start of the year. The stock fell 33% in April because of tariff worries. But after that, it shot up to new record highs by June, driven by excitement over AI. Traders who bought Nvidia when it was down made big profits as it climbed back up. For a trader, these kind of ups and downs are opportunities to buy low and sell high, making strong profits along the way. The point I want to make here is that you need to know where the action is. It's a trader's paradise in the sense that informed, active participants can rotate between teams, buying dips on the winners, perhaps even short or avoid the losers, and thereby outperform other people. But if you just set your portfolio on cruise control, you might be up only marginally or stuck in underperforming positions while the index headlines look great. Now, I want to address a key point. I'm not saying long-term investing is dead or that you should abandon all your value investing principles. However, market conditions change, and right now we are in a phase where trading tactics have an edge. It's important to recognize this so you can adapt your mindset and strategy accordingly. Let's consolidate some actionable insights from everything we have discussed. How can you, as an intermediate trader with a portfolio, make the most of a record high market instead of feeling paralyzed by it? Here are a few key principles. Embrace the volatility. Don't fear it. Volatility is your friend right now. Big swings equal big opportunities. When you see the VIX or volatility index spiking or huge intraday moves, think of it like a trader. This is a chance to trade, not a reason to panic. Of course, always manage your risk, but adjust your mindset to welcome volatility as a profit opportunity. Then focus on the leaders and know what are the laggards. You want to be in what's working and avoid what isn't. Use both fundamentals and technicals to identify the leading stocks or sectors. Who's making new highs? Which industries have strong tailwinds? Which stocks are above key moving averages and showing strong momentum? Those can be potential stocks for long trades on pullbacks or breakouts. You see, a trader's market often reward rotation. Today's leader could cool off while yesterday's laggard catch up. So stay flexible and rotate your focus as new trends emerge. Also, be news reactive but not news chasing. There's a fine line here. You want to be aware of news catalysts, for example, a sudden tariff announcement, a central bank surprise, or a big earnings beat or miss, and react when there's a high probability setup. But you don't want to randomly chase every headline with impulsive trades. Develop a sense of what news truly shifts the supply and demand of a stock. A helpful approach is to plan if-then scenarios in advance. If the Fed signals a rate cut earlier than expected, then I expect growth stocks to spike. How will I play that? Having a game plan means when the news hit, you are prepared to move rationally, not emotionally. Then use technical analysis for entry and exit. In fast markets, timing your trades well can make a huge difference. Technical analysis helps you pinpoint entry and exit points. This could mean buying near support levels, selling or taking profit near resistance levels, and watching indicators like RSI or MACD for momentum shifts. In 2025, with so many retail traders active, we have seen technical breakouts pattern play out quite often. When a stock cleared a previous high on strong volume, it tended to attract more buyers in a self-fulfilling move. So, brush up on those charts patterns and indicators. This one, very important, risk management is king. I can't emphasize this enough, but volatile markets can make or break you depending on your risk management. Always know your exit plan before you even enter a trade. Use stop loss orders to guard against a trade going too far south. Position size should be such that even if you're wrong, it's not devastating. One rule of thumb many pros traders use: never raise more than 1 to 2% of your trading capital on a single trade. That way, you have to be very wrong many times in a row to seriously dent your account. Remember, capital preservation is the key of the game. If you protect your downside, the upside will take care of itself. In a trader's market, opportunities are plentiful, so you want to be around to catch the next one, even if the last one didn't work out. Cutting losers fast and letting winners run is the classic mantra that absolutely applies here. Finally, keep your emotions in check. Fast markets can be exhilarating but also stressful. The goal is to approach it with a professional mindset, like a mentor guiding you. Stick to your strategy, reflect on mistakes calmly, continuously learn, and don't let FOMO push you into making bad decisions. Yes, you might see others bragging about big wins while you're on the sidelines, but trade your plan, not someone else's. The irony is, in the market at all-time highs, the fears of losing out can lure people into buying at precisely the wrong time or chasing too late. A trader tunes out their noise and follows their signals and logic. Speaking of learning and mentorship, that brings me to the next part. You don't have to navigate this all alone. Everything we have discussed today, from technical analysis to reading news to sharpening your trading mindset, these are skills to learn over years. And one of the best ways to accelerate your learning curve is to learn directly from experienced professional traders who have seen multiple market cycles. That's why I'm excited to announce an upcoming webinar that I'll be hosting in collaboration with a pro trader whom I really respect, Jose Blasco. If you haven't heard of Jose, he's a multi-asset trader with well over a decade of experience in the markets. He started trading around 2008 and, like many of us, went through the school of hard knocks during the global financial crisis, then navigated the long bull market and the wild swings ever since. Whether it's a short-term scalp trade or a long-term position, whether it's an equity or a forex pair, Jose has likely traded it. Beyond just trading, Jose has a passion for teaching and technology. Since 2011, he has been sharing his methods as a trading instructor, appearing in live seminars and online trainings to mentor other people. He even went on to develop innovative trading tools and technology that I've talked about before in my previous videos. These tools aim at helping traders gain an edge. With an engineering background, he brings a very analytical and systematic approach to trading, which I think you'll find incredibly valuable. And he's truly global. He's taught students around the world and is known for being able to explain complex concepts in a clear, practical way. In our upcoming webinar, Jose Blasco will be joining me to pull back the curtain on what it takes to trade successfully in markets like this. We are going to dive into the insights, skills, and tricks that professional traders use to thrive when the S&P 500 is at all-time highs and volatility is swirling. I want this session to directly address the challenges you might be facing and the questions you might be asking yourself. So I warmly invite you to sign up for the webinar with Jose Blasco. The details of the registration are in the description or on our social media platforms. It's happening on the 24th of July. It's a Thursday at 8 p.m. But spots may be limited, so definitely reserve your seat. Whether you're male or female, young or not so young, if you're an intermediate trader or even a motivated beginner who have been following along, I believe this event can be a game changer for you. It's not every day that you get to learn from someone with a proven track record and a genuine passion for teaching others. And it's completely in line with what FAQ Show stands for, bringing you opportunities to learn from experts and elevate your own financial game. Most of all, this webinar is completely free. I hope this discussion has given you not only information but also inspiration to take action. The market will always be changing, throwing new puzzles at us, and that's what makes it fascinating. With the knowledge and strategies we've talked about, you'll be better prepared to solve those puzzles and profit from them. Thank you for joining me on this deep dive. If you found value in this discussion, please give a thumbs up and share it with others who might benefit from it. Drop a comment if you have questions or if there's a particular aspect you'd like us to explore further in the webinar. I look forward to seeing you there. Until next time, see you soon.